Hello, economics students. Today we're going to be looking at learning target 6C, which is exchange rates. The target is to be able to explain how the demand and supply of currencies determines exchange rates and in turn affects trade. I recommend that you read pages 299 to 303 in your textbook, as I think this will help further your understanding of today's topic, which can be a little confusing at first, but we will be looking at examples in class. So, to begin with, what is currency used for? This is an example of United States dollar. This is an example of the Canadian dollar. Currencies can be traded for or used to purchase goods and services, financial assets, and other currencies. Most countries have control over production of their own currency, so they can decide how much they want to have in their in the economy. And in the United States, it's the Federal Reserve Bank that has control over the amount of currency that is produced. Some countries share the same currency, and some rely on another country's currency. Additionally, some countries will take currency, for example, parts of Latin America will take US dollars instead of their own currency because they value the US dollar. In the US, we hold what we call dollars. Canadians also call their currency dollars. However, Japan has the yen, China has the yuan, most of Europe has the euro, with the exception of a few European countries. So we don't demand dollars on the international market. We supply them when we are trying to buy other currencies. Okay, so then when we want to buy goods or financial assets in another country, we use the foreign exchange. So we need to exchange our US dollar for the currency used in that country. So let's say we're going to go to Europe. We would supply US dollars in the foreign exchange market and demand euros in return. What I did when I went to Europe the last time is I went to my local bank and I asked them to take $500 that I had in my account and to convert that to euros, and so that I could bring them with me to Europe. If you want an idea about how much money you'll get in exchange for your American dollar when you're traveling abroad, you can go to a currency calculator such as this one. So let's say that you have about, and by the way, this is a day-by-day thing. So this is January 12th, 2021. As you can see on this chart, the value of the dollar against the euro has widely fluctuated. In fact, it reached quite a low on January 6th, and it has come up quite a bit since then, comparatively speaking. But let's say that you have 500 US dollars. That would give you 410, approximately 411 euros. Let's say, however, you are going to go to Costa Rica. You're going to get the colon. 500 US dollars would be worth 307,407 Costa Rican colons. So again, I wouldn't take this particular date and say that's how much money if I go to Costa Rica in a year I would have. But right before you travel, you can take a look at the currency calculator and figure out how much your US dollars will convert to in the local currency of where you're traveling to. I am traveling after I get my vaccine, hopefully to Mexico. I really enjoy Mexico, and the Mexican peso, $1 of the US dollar right now is worth about 20 Mexican pesos. And again, you can see from this chart that it varies from day to day. And there are a lot of powers at work that determine the value of the dollar, and the dollar fluctuates quite a bit over time. So let's look at an example of importing coffee beans from Brazil. So Brazil is the world's largest exporter of unroasted green coffee beans, and they are imported in bags, burlap style bags like you see in the picture, weighing about 69 kilograms. The price is 2 Brazilian reals per kilo, and so the entire bag would be 138 reals per bag. So using the currency calculator and the exchange rate for Brazil's real, we can see that as of today's date, January 12th, 2021, the Brazilian real is worth 18 cents, of a US dollar. So we further our conversion and considering the exchange rate for Brazil's real, considering the cost in reals per bag of coffee, then in US dollars, we do some simple multiplication. We take the price in reals, which is 138 Brazilian reals, times the price in US dollars, which is 18 cents, and we get a total of $24.84 per bag in US dollars. So that is what we would be exchanging in order to purchase the coffee in Brazil. Let's take a look at Colombia. U.S. buys actually more unroasted green coffee beans from Colombia than from Brazil. So again, the bags are imported, or the coffee rather is imported in bags weighing about 69 kilos. The price is 200 Colombian pesos per kilo. That sounds kind of a lot, right? So in Colombian pesos, we're going to spend 13,800 per bag. Again, it sounds like a lot, but when we look at the exchange rate, and think about this for a second, this is not even worth a penny. 1 Colombian peso is not even worth a penny in US dollars. So let's figure out how much the bag of coffee would cost once we convert the Colombian pesos into US dollars. So we take that price of the coffee in Colombian pesos, 13,800, times the value of the peso in US dollars, and we actually get a price of $4.28 per bag in US dollars. So actually we have a pretty good price for coffee from Colombia. Okay, so exchange rates will fluctuate on nearly a daily basis. So let's take a look at an example of what happens when exchange rates change. So in last year in Brazil, early 2020, we were looking at about 27 cents in US dollars to 1 Brazilian real. It would cost the US $37.26 to buy 1 bag of beans in US dollars with that exchange rate. The exchange rate for Brazil's real on this date that I'm recording this, January 12th, 2021, has changed to 18 cents to 1 Brazilian real. So we take the same amount of coffee and we multiply it by the new exchange rate, and now we're paying $24.84 in US dollars to buy 1 bag of beans. So what would you expect to happen to coffee prices in the US? This is an example of a shift in price, and we would expect the coffee price to go down if the US dollar is worth more in comparison to the Brazilian real, or the Brazilian real is worth less in this case to the American dollar. So as one goes up, the other goes down. As one goes down, the other goes up, and it's impossible for them both to go up or both to go down at the same time in relation to each other when you're talking about any two different currency exchanges. Let's talk about supply and demand influences. Supply and demand for a nation's currency changes its price. The price is called the exchange rate. These are called floating because supply and demand for currencies around the world are constantly changing. The exchange rates, if we're talking about US dollars, tells us how much in US dollars we need to buy foreign currencies and or their products. If a demand for a foreign currency increases and the supply remains constant, the exchange rate will increase, so the foreign currency appreciates. So in other words, we have a demand, let's say we have a higher demand for the Canadian dollar, then the exchange rate for that dollar will appreciate and the price will be higher. So the price of the Canadian dollar will be higher for us if the demand for the Canadian dollar goes up. And there have been times if you look at the history of the Canadian and the US dollar, there have been a lot of fluctuations over the years depending on trade and other foreign investments. Demand influences. If the US demand for foreign currency increases, if the US inflation is higher than inflation in that country, then the US purchasing power decreases and the purchasing power in the other country increases. So, for example, if the US inflation rate goes up in the next year, while Canada's does not, then the US purchasing power for Canadian goods is going to go down. Another example that might affect demand is that US interest rates are lower than interest rates in that country. So money from the US may shift to another country as people invest in securities from that country. Supply influences. The supply of currency is determined by the domestic demand for imports. Now, we've already talked about the fact that we import many garments from China. What this will do is when we import garments or other imports, then the supply of US currency in the markets in the foreign markets will increase. When the international supply of the US dollar increases, if you look at the equilibrium point here, it decreases the price of the US dollar. So, what is the difference between a strong versus a weak US dollar? You can pause this and read over all of these examples, but I'm going to highlight just a couple of things, advantages or results of a strong US dollar. When the US dollar is strong, we can buy more of other currencies. So let's say the US dollar is strong against the Japanese yen, then we can buy more Japanese yen. The goods in other countries become relatively cheaper. So with the example of the yen, if we're purchasing something from Japan, automobile, for example, then that will make the automobile less expensive in US dollars. And the demand for imported goods increases, and the demand for US goods decreases, relatively speaking. Because the US dollar is strong, we're going to want to buy more things from outside of the US because we're going to get more for our money. However, that leads to a demand decrease for US goods and lowering of exports. So this second to the bottom line here, more imports, less exports, increase in trade deficit. Okay, that's when the dollar is strong. Now we talk about, when it comes to currency, appreciating and depreciating values. Currency appreciation is when a currency becomes stronger. So for example, if the US dollar is strong, the increase in the value of the US dollar in relation to other countries' currencies is strong. We can buy more from that other country. If a currency depreciates, that means it becomes weak in relationship to another country's currency. So if the US dollar decreases, for example, against the Chinese yuan, we will get less Chinese yuan for US dollars. So what can we conclude? And I think this is the most important part of this whole presentation, to be perfectly honest. Supply and demand for currency does affect the exchange rate. It is going to change on nearly a daily basis. A stronger dollar leads to increased demand for foreign products and less demand for domestic products. As we have already talked about, the US has a trade deficit, and part of the reason for that is because we have had a fairly strong dollar. And so we have a high demand for foreign products and less demand for products that are made domestically. A weaker dollar lends to decreased demand for foreign products and an increased demand for domestic products. That is because we cannot afford to buy as much if our dollar is weak from a foreign country. So our currency values and exchange rates in the end affect product prices, consumer buying habits, and our overall economy. I hope that the importance of international trade has been clear in this unit, and thank you for your time. We will be looking at examples in class. Goodbye.